Okay, folks, we are live and let's jump right to the futures action with the S&P 500 gapping down here, which is kind of what I expected. It doesn't mean we're going to open here tomorrow. It just means that the market is a bit suspect at this point in time. So we're literally in the first minute of the new trading week. We don't want to draw any conclusions, but what we do want to do is weigh the balance of what is going on out there, and in particular, over in Europe. Now I'm going to set my alerts here, and I'll come back to them in a moment. But we're going to do a little bit different, a little bit of a different segue this week into Sunday Night Futures Live. And my camera's not working. Bear with me 1 second. I may need to do this without my camera today. What is going on here? I see me there. Virtual background. Okay, I'm not sure what's going on with the camera. I'm having a bit of a technical issue here. This was not happening 10 minutes ago. God, it's so aggravating. Okay, I'm going to try to talk my way through this as I try to fix everything at the same time. So, as you know, the war in Ukraine has only gotten worse of late. And over the weekend, I may now be working. Okay. I really apologize. Okay, we're back. Okay, so over the weekend, you can see that we're coming back off the lows of the session. Let's talk a little bit. I want to let the market settle out here. Let's first go to what is going on. So over the weekend, we had a major attack by Ukraine. Let me play the video. It's pretty wild. I'm going to pause there. I want to make sure that I am sharing the audio. I don't think I am. I was not. Okay, let's try that again.
What the show?
So apparently what had happened was that there was a massive drone attack by Ukraine into Russia. Zelensky boasts of absolute brilliant longest-range strikes while Kremlin confirms terrorist attacks. Apparently, these attacks went deep into as far as Siberia. Now, this is just the initial reporting. We don't know. This is the fog of war. So we want to take everything with a grain of salt right now. Prayers out to everybody that may have been hurt by this, but it seems destroying Russia's strategic. This is the problem here, folks. Seems destroying Russia's strategic bombers wasn't enough for Ukraine today. The city of Severomorsk that houses Russia's nuclear submarines is no longer not violently exploding. So the reason why I made this the topic of tonight's video is that these attacks impacted Russia's nuclear bomber fleet. It impacted their nuclear submarine fleet. So the perception inside Russia is that this is no doubt a Western-backed planned operation to try to take out their strategic nuclear power, to reduce them. So there will be retaliation. The size of that retaliation is going to be immense. I shudder to think about what the retaliation is going to be. And I think it's the anxiety over that retaliation that's going to put the markets at a little bit of doubt of where to go from here. There's some good news to talk about in the equity markets in terms of valuations as measured by the Buffett ratio. But that's not enough, not when you have a potential widening of this war, and the rhetoric coming out of Germany of late has been pretty loud and clear. So the other headline that came out over the weekend, as if this attack on military installations were not enough, you had 2 bridges blow up, trains derail in Russian regions bordering Ukraine, killing at least 7. So if it's deemed that these were attacks by Ukraine on civilian targets, then you're talking about World War II type stuff. No holds barred type of attacks. You're talking about cities being decimated and leveled potentially. So this is a real serious escalation of this war, of which I really haven't talked about that much. I thought that we would have peace by now, but it appears as though the powers that be in the West do not want peace. They simply do not want it. And frankly, it looks as though Putin is playing hardball as well. Now, what does this mean for us going into the new trading week? Well, we need to take a look at obviously the global impact on the equity markets, but in addition to that, a volatility spike, commodity price surges. We saw commodities last week drop. I spoke about this in great deal on the week ahead commentary, which goes out to members. So we saw this drop. It looks like it wants to go lower. This could send this actually higher, driven by potentially natural gas. We'll go with that chart in a moment. Anything that's in that area of the conflict can influence our commodity prices here. And what does that do? If commodity prices go up higher, guess what happens? The probability of any Fed intervention, which is low already, goes even lower. So this is going to be an interesting day. Let's go back to the futures market. Now that we know the whys behind the gap down, again, we don't know if this is going to be the way we open tomorrow morning. A good market, a healthy market would shrug this off. But if it doesn't, and we continue to sell off, then that means that the market is looking for a reason to go lower. So we're back to a 5-minute chart on the S&P 500. We have a bit of a ascending wedge formation. You know, it can go either way here. I'm drawing no conclusions. I'm not bullish on the market, but I'm not betting on a stock market collapse either. When we have a short position on the triple Qs, and we remain short, we have long positions as well. Not in the Qs, but in other areas, which we're doing very, very well with. Let's take a look at the NASDAQ. The NASDAQ is down about 1/4 percentage point. I just want to set up some alerts here. I want to know if we break down to new lower lows or if we begin to gain steam to the upside and begin to proceed higher and shrug off this news. It may be all to do about nothing, but I don't think that it is. If the markets do shrug it off, I think it may be a little bit premature to do that. Let's take a look at mid caps. Mid caps down only 0.10%. The Russell 2000 down just shy of 1/3 of a percentage point. I want to go back to the NQ for a moment. This is the NASDAQ 100 futures version. And I want to point out this is an intraday setup here. Left shoulder, head, right shoulder. And we technically broke the neckline on Friday morning, but we were able to recapture it. So this is a market that's a little bit wobbly at current. Let's take a look at volatility. So we have the equity markets down, volatility up, which makes sense. Now, the weekly chart of volatility was not a pretty sight. But we are holding a support level at current. This is a weekly chart. Let's go back, 5-minute chart. I want to know if we take out highs on volatility. This is really the confirmation. If you see markets sell off with no confirmation, with volatility moving higher, we could easily rebound and move up higher tomorrow morning on equities. If you get a sell-off on equities and a rally in VIX, that's really traders are picking up insurance policies against their long bets or speculating short using volatility contracts. So at or above, I really don't care about if we make lower lows here. Checking in with the currency markets. Dollar opening up. Doesn't look up. It is up. Relative to the close on Friday, it is up at current. Let's check in with the yen. Yen is down fractionally. Where's the euro? There we go. Euro is down fractionally as well. I'm more bullish on yen and euro right now than I am on the US dollar. So I think that in all probability, euro yen, if they're probably going to rally up higher. Now, let's take a look at what they're doing with our bond market here. Bond yields are down a bit, 0.29%. Let's check in with silver. Silver gapping up here in a very big way. Up over a 0.5 percentage point. Real pretty chart here. Real pretty. This is on a 15-minute time frame, very small time frame. You can see you have a Bollinger Band squeeze setting up here, and this is firing off to the upside. Let's take a look at a 4-hour view. You have a 4-hour Bollinger Band squeeze. That's more significant. I want to know if we do, in fact, break out, because we could be putting on long bets on silver. More long. We already long silver. More a bigger bet. A bigger bet, I should say, on silver. Check in with gold. Gold moving up by about a 0.5 percentage point. It, too, is in a nice Bollinger Band squeeze. What that means is Bollinger Bands in orange trading inside the Keltner channels or close to it and looking very, very bullish intraday. However, we saw a breakout point failure last week on gold's breakout on a daily time frame. That was the second failure in the past few trading days. So I'm a little bit suspect right now of gold. But with this news out of Europe, I'm more bullish than what I was when I was preparing the week ahead commentary over the weekend. And this is a 4-hour breakout. I'm going to take a pause here. I'm going to say hello to folks. We have about 83 people on. If I can get 83 likes, I'd really appreciate it. Like, subscribe, you know the deal. Larry, indecision is the thief of opportunity. Do we short or go long the market this week? I like my positions. I'm going to stay short of the Qs for now. I'm going to stay long of the industrials that we have on Boeing. I'm not that bullish on the energy stocks that we have. However, I'm willing to build on them if oil begins to move up higher. In fact, let's talk about oil at current, because we know the oil space, I should say the energy space, has been weak, but it's highly correlated. Wow, look at this. Oofa. Highly correlated to the price of oil. Oil is moving up higher. And this is why I mentioned earlier the CRB commodity index was weakening. The Federal Reserve may say they don't look at food and energy. They look at food and energy. So energy prices moving up higher here, not good for the Federal Reserve's moving in to help buoy the market. Not that they're sidelined anyway, to be honest with you. Evening to you, Tim. Nick, welcome. Miss Polish, Taco, welcome. Mr. Pete. Oh, this ain't good. Peace talks are done. Oh, yeah, they're done. They're not going to talk until they have retaliation. The lovely Jody. Hello, Bob. Hey, Paul. How you doing, pal? Mr. Jeff. All right. Lee Cable, we are due cycle lows for stocks and crypto this week, so watch for the narrative for the drop. We are due cycle low. So what are you saying? Are you saying that you're bearish or bullish there? We are due, meaning that we are pending a low for stocks and crypto this week. I don't know about Bitcoin. Bitcoin, last look, it was trading up. It did not look good late last week. Let's bring it up right now. But it may be a go-to along with gold on this news. Because Bitcoin has not been trading. Yeah, we're up a percentage point now. Bitcoin has not been trading to the downside with equities lately. It's been trading up. So it's probably more correlated. This is anecdotal. Probably more correlated to gold right now than equities, which forever was not the case. But that story may be changing a little bit here. And I think it's due to the fact that you have all these ETFs out there that are now firm hands of Bitcoin. You're probably seeing a bit of reduced volatility in Bitcoin. Okay, let's check in with Natty Gas. Natural gas up over 2.25%. So energy up, Precious metals up, stocks down, volatility up. It's pretty much what we expected. But equities are really in a tight trading range. So I can't say that I'm seeing a lot of panic here. It's a move lower. I don't think that by any metric we see any type of panic, but we do see people that are buying protection, whether it be gold, silver, bonds, dollar. So, yeah. Bonds at current are moving up fractionally. Let's go back and take a look at, here, let me bring it up on the big chart. So this is the 10-year micro futures contract. What the heck just happened? Try that again. There we go. So yields are moving lower. Funny part about this, they were moving lower after the close on Friday. So we're actually off the lows of Friday's close. Interesting. Maybe somebody was in the know. So bond prices at current, to answer your question, are going up. Short-term bearish until mid-June, then either push to new highs or roll over and failed weekly cycle. Okay? I don't think we're far off. All right. I didn't cover, not that we really need to, but out of habit, I like to go over commodity, food, agriculture. Soybeans looking weak. Let's go to the weekly chart. That's not what I want. Tight trading range, Z, C. Corn looking bearish. Look at this resistance here. This is probably going to break. I think corn's going to break lower. You have a lower high here. We've already taken out the prior low. I think that this is a check back. Corn is probably going to break lower. I may put a short on here. Wheat. Nothing to do here. Tight trading range. Okay, let's get to the week ahead. So this is probably going to be in the rearview mirror. This, again, is the CRB commodity index. We pressed lower last week. It looked as though we were going to move lower into this new trading week. Maybe we do. Maybe this is just a knee-jerk reaction, and we sell off midweek and we press the new weekly lower lows. Quite possible. All right. For those not already a member of our free forum, head on over there. This is where you enter your symbols for stock chart requests. There's going to be a lot of changes made soon. So sign up while you can. It's free, no credit card required. Let me just see if I have any more requests here. I do. Polish Taco, you may want to use this thread here because if I didn't refresh, I wouldn't have seen your request. UNH. Okay. All right. All right, so folks, the show is going to be brought to you by our friends over at TrendSpider. Analyze charts and data, find great trading ideas, and frankly, have the best charting tool in the industry. I use them since 2017. A big believer in them. I believe in them so much, I give it away free to our silver and gold level members. So please head on over. You'll see me demonstrate the power of it in a little while. It's just a time saver, and it allows you to be more efficient with your time and enter trades with a rules-based approach. If this, then that, meaning you set your alerts, you set them and forget them. If they don't meet your criteria for entering a trade or exiting a trade, then you don't enter the trade. That's the discipline that TrendSpider brings to you, along with automated trend lines, automated technical analysis. So head on over, link below on YouTube, link above on Facebook and on Twitter. So check it out. All right. I want to begin with last week's. OPEC. The other reason why oil is popping here, oil prices jump after OPEC agrees to another sharp production hike. Why would their prices be jumping if it's not for Ukraine? They probably got pressured by us to do this in light of the events over in Ukraine. That's probably why this news is breaking on a Sunday night when the futures just opened up. Buckle up here, folks. It's going to be a big volatile news week this week. I'm just checking the headlines now. I don't know what's going on with Jamie Dimon, but he seems to be freaking out here. Big bank boss urges America to stockpile bullets, not Bitcoin. We should stockpile guns, bullets, tanks, planes, and drones, rare earths. We know we need to do it. It is not a mystery, Diamond said, referencing President Trump's executive order in March to establish a Bitcoin reserve. Okay, he's not a happy camper. And yeah, China. China seems to be behind everything nowadays. China. Okay, let's talk about the reports that were released last week that could influence trade going into this week. Durable goods are contracting. They expected them to contract by 7.8%. They came in worse. But think about it. For those folks that are not familiar with what durable goods are, it's a big ticket item, washing machines, dryers, refrigerators that last a number of years. And there's no demand right now. It's negative demand. Consumer confidence, that came out better than expected. We know the minutes by the Fed. They're on the sidelines. GDP. I don't understand this. Economy shrank 0.2% in the first quarter. Updated GDP shows as trade wars sapped U.S. growth. So GDP shrank in the first quarter. That kind of conflicts with Atlanta Federal Reserve's forecast. So I need to do more. This is the report. I can't argue the report. I just question the accuracy of the report. But it came in worse last week. Consumer spending came in on par. PCE index, that's the Federal Reserve's favorite measure of inflation, came in as expected. Year over year, declined a bit, and that's their key number. At the core, this is what they really watch, ex food and energy, flat year over year. Consumer sentiment, final. We're still in expansion here. Any read above 50 is a sign of expansion. Any read below is a sign of contraction. Now, looking at the possible, actually, let's go to the reports coming out this week. So on Monday, we're going to get the S&P U.S. manufacturing PMI. Construction spending, that's an important number. So this week is a jobs week. It begins with on Wednesday, the ADP report. And then on Friday, you get the pimp Mac daddy of them all, non-farm payrolls. Big, big number. So not a lot of reports coming out this week, but the ones that do come out can move the market. As for the Federal Reserve, let's update this. I've just been skipping ahead to September because July, there's no chance of a Fed rate cut. We're above 90% probability of a rate cut for July only a few weeks ago. Now we're looking out and into September. The probability of an ease is up from where it was mid last week at 74.8%. And October is also increased back above 80%. That was below 80% mid last week. So could it be the contraction on GDP? Perhaps. I think you need more than a 1/4 number for the Federal Reserve to move. And in terms of the Federal Reserve's balance sheet, they're not projected to cut rates anytime soon, but are they slowing down the selling off of debt off of their balance sheet? That can serve as a pseudo or a quasi way of making yields go down and bond prices go up because they are a net seller. Take that seller out of the mix and yields can move lower. And the answer is no. They were a big seller the past couple of weeks. So by no stretch of the imagination is the Federal Reserve part of the conversation of as to what's going to make the stock market move up higher. They need an event. They need an event so that they could ride back in and say, okay, here we are, the central bank of last resort. We're riding back in yet again to save the market from a problem that we probably created, but we won't admit to it. But we're going to save the market again. And we're going to begin by cutting rates. We'll begin to stop selling debt and perhaps even increase the balance sheet yet again. And that'll impact the longer term debt yields. They have very little control over longer term yields, believe it or not. The overnight rate, Fed funds rate, short term rates. It's a myth that they have the power when cutting rates for the 30-year, 10-year, 20-year bond yield to pull back lower. Look at what they did when they cut by a half basis point a few months ago. Longer term yields went up, not down. Taking a look at the valuation of equities, we have kind of a mixed bag here. So in terms of the trailing multiple, the Shiller or the CAPE ratio, we're at 36.29. Very, very expensive. Now, I hadn't gone over the Buffett indicator in a while, but I figured, you know what? Since we had GDP come out and since we have earnings by and large done, let's talk about the Buffett indicator because it measures the valuation of the stock market relative to the GDP of the United States. And the last I looked at this, we were strongly overvalued. Now we are just simply overvalued. So while we're still very extended beyond the historical trend on valuations, and we have a long way to go to get to that historical trend, the good news is that we saw the Buffett indicator begin to come in a little bit over the past month or so. Now, some more good news. With 91% of companies reported, the S&P 500 operating earnings are on pace to hit another record TTM trailing 12-month, up 10% over the last year. Good stuff. At a fact set, 78% of S&P 500 companies have beaten EPS estimates to date for Q1, which is above the 5-year average of 77% and above the 10-year average of 75%. So this is a good-looking chart. The thing to remember, though, is that they're beating reduced expectations. So don't let these charts that they put out there, FactCheck's a pretty good organization, but you need to read between the lines here. They're beating already reduced expectations. All right, we went over Zelensky. I thought we'd talk a lot more about that, but we didn't. Let's talk about some charts I want to go over. Again, folks, we're going to be using our friends over at TrendSpider. Head on over, use that link below, and take advantage of our 35%, bare minimum 35% discount code. Sometimes they run specials that you get a better discount, but please use my link. And they know that we referred you over, so it helps our relationship with TrendSpider. Let's go to the comments. Lee, do you see a VIX spike above 25 this week? Not yet. No. If I would have seen new lower lows on the NASDAQ and the S&P 500 right away, we gapped down, moved up, and I set alerts, and they haven't fired off yet. So by no stretch of the imagination, you're seeing panic selling here that would drive up volatility above 25. Not yet, anyway. JD Probe just wants JP to lower rates. The banks, the banks really don't care about the yields all that much. The regional banks do. The regional banks care about interest rates because of their commercial loan portfolios. Because if interest rates go higher, these commercial, especially office space, they took out these big loans 5 years ago near 0%. Now they got to roll them up over at 4.5%, 5%. The banks, the tenants will just hand in their keys, and that hurts the smaller banks. The big banks like J.P. Morgan, they just make money off their loans, so they're really immune to interest rates. So I don't think that's an issue with them. I think that with Jamie Dimon, I think that he's at this point in life where he's worried about legacy, and he's more of an elder statesman of Wall Street, if you will. I'll put it that way. Yeah, it's a toilet out there when it comes down to that business. So very, very bad business right now. Okay, let's do some chart requests here. First up, we have CVX. All right, so we're going to go to the weekly chart first. The weekly chart does not look great here. To me, it looks as though we have a bit of a bear flag setup, but I think I'm about to change my tune because of the daily chart. We had a failed breakout back here the week of May the 12th. Now, on a daily time frame, we're in a trading range. We stopped going down back in early April. But something happened last week, and I wouldn't have picked up on it were it not for the fractal trend lines here. And you could see that we broke out on the 27th. And we're probably going to get follow through on the spike up in oil tonight, tomorrow morning. So my guess is that CVX is probably going to spike up tomorrow morning. I would watch the weekly chart to see whether or not we close there or do we fade. We have Fibonacci resistance right above here at 139.36. We close above there, and you could have a rally on your hands for Chevron moving forward. And all these indicators are clicks of a button. Here, Fibonacci's, fractal trend lines here, and of course, the trend lines. So CVX, I think, is going to do well this week. That's the short-term view. The macro view is that it stopped going down. It's worthy of keeping on a watch list at current. TDOC. So we are in a downtrend channel. You have resistance immediately above. I'm going to overlay, the automated trend lines. You have support immediately below and resistance immediately above. So you need to take the approach of if this, then that, rules-based approach. If we manage to break out and close above $7.72, then you could open up a long bet. The however is that if we fail to hold this weekly support level, then it becomes a short bet. Not that I would short it. Let's take a quick peek at what the insiders are doing. We'll go over the seasonality as well. You're seeing stock being awarded and they're not selling, which is a good sign. Seasonality. June is the best month out of the year to own this stock. So from a seasonal perspective, June and July are good periods to own the stock. I'm looking more towards a possible breakout. And in fact, I want to drill down further now that we're armed with a little bit more information, to an intraday chart. You have a potential W formation here. There's the pivot point, $7.34. We have an alert set up here already. There we go. There they are. So I'm not going to set up any more. But this is interesting. If we do get that breakout, I would want to check short interest. If it's heavily shorted, let's answer that question now. I want to take a look at a couple of things. One is short volume. This is not short interest, but short volume. You can see the number of shares are being shorted have dropped down dramatically. The however is, I've seen no signs here that the shorts have covered. So let's get curious and take a look at the level of short interest in this stock. Jesus Christ. What's going on here? Sorry about this. Only when I'm live. Okay, so statistics. I don't use the percentage of shares held short. I look at the number of shares held short. Wow. Wow, 21.61 million shares. Why does that matter? It matters because the average 3-month volume on this stock is 5.7 million shares. That's a multi-day short squeeze in Teladoc. Interesting. So from a long perspective, we like it. Now, here's a daily chart of Teladoc. We gapped down, tested support on Friday. We broke out of a downtrend fractal, downtrend channel. I think the stock is going up. We like it. We like it. Bullish Teladoc. All right, let's move on. Which one do we have up next here? U.S. Steel. All right, so U.S. Steel. This, I think Jody asked for this one. I probably sold this one prematurely. We had a profit. It still is extended to me. This is a 2 or 3 standard. It's a 3 standard deviation Bollinger Band. So I decided to make profits real. I probably booked them too quickly because when I sold them back here, I expected a pullback. We really didn't get, we got a pullback, yeah. But we're holding a support level, and I really should have looked more closely at the trend lines. So were I long right now? Would I sell the shares? No. Would I buy the shares? Maybe. It looks like it wants to go up. The however is that we can't get away from the fact that we are trading right up and into that 3rd standard deviation Bollinger Band. So if you get long here or you have a profit, you want to use a trailing stop loss order to get you out as soon as possible when things start to get a bit ugly. I think we're going up. We made 27% on the trade, so I'm not going to cry about it. And maybe I'll buy it back, but I think it's going higher. So bullish on U.S. Steel. Let's check out the seasonality. Seasonality, this stock's been beaten up. This 34 years is a little bit too much data. Let's drill down a bit. Let's go from 2010. July is a good month. June, not so much so. The best time to own it is October, November, December. But let's face it, the stock has been strong during these 3 prior months of very, very historically poor price action on U.S. Steel. I think the headline news is supporting the stock. You have President Trump backing that Nippon deal. So I think the stock goes up higher longer term. What are the insiders doing? They're being awarded and they are not selling. Okay. GRAL. You're welcome, Jody. All right. So simply by using the candlesticks here, this is a bearish key reversal. So right off the bat, I don't like it. You have Fibonacci support immediately below at $37 per share. If it breaks that, you're going lower. And I think it is going to break because on a daily chart, we broke this ascending wedge formation. I've never looked at this stock. This is the automated trend lines. Bam. So what may happen here is similar to what happened back here, is that we broke down, did a check back. This time, though, it held, but now it's failed yet again. So I think that we can move up higher here, but I think ultimately it's going to fail and move lower. I don't like it right now. I would avoid this stock. Let's take a look at what the insiders are doing. Well, actually, seasonality first. There's not enough data for seasonality. I don't care about the analysts. What the hell is this? Alumina. So it looks like we have Alumina as an investor here. I would look to be a buyer if we do get a continuation pullback down here. 31.35. That's the price. UNH. Okay, so UNH, I've done some videos on UNH, and let's face it, folks, we were right. HSBC is so far very, very wrong about their 270 price target. I said that they were trying to do a fishing expedition, trying to get a liquidity hunt going. That's probably what they did here. I've been reluctant to do a follow-up video until I'm very confident that they are in fact dead wrong, and we were in fact dead right on buying the stock. I'm still long of it. I haven't sold it. As a matter of fact, when they sold it off, I bought more. So thank you, HSBC. We are now profitable on those shares. The fact that we were able to close above $300 per share last week was very, very good. 300 has been a little bit of a resistance level since that price target downgrade. Let's take a look at it on a weekly view. You know, whenever somebody asks me about a stock that's been through hell, meaning it's been sold off very, very heavily, I use a very, very simple set of rules. Very, very simple. Has the stock stopped going down? The answer is yes. And when we bought this stock, we were down here at weekly support. Nobody wanted this thing. We had RSI with an 11 handle. Ridiculous. S&P 500 stock, leader in its field. So we held our nose. We bought the stock, and we've been buying more. Thank you, HSBC, for your downgrade. Do I think that we move up higher? Yes, in all probability, because what you're seeing build here is a compression zone on UNH stock. What does that mean? Well, as I mentioned, it stopped going down. So you're getting more and more of a tug of war between bulls and bears, and one of them is going to win out. And this is historically cheap stock. So I think that this stock is going to break out higher. I think I'm done buying here. Maybe I'll buy more if I see a really good high probability setup. But right now, we're good. So I think we're going to break out, long story short, bullish longer term. This is an investment for us. Daily chart, I like the fact that we closed above 300. I think the path of least resistance is to the upside. Let's take a look at the seasonality here. This goes back 35 years. We're going to reduce that time frame a little bit. Again, let's go with 2010. And you can see how the picture changes here. So June is a very good month, as is July. And in fact, these 2 months are tied. Actually, 3 months are tied for being the best 3 months out of the year for UNH stock. So we like it. Add to that the insiders are doing exactly what HSBC wants you to think that they're not doing. They're buying the stock. This is the new CEO right here. This guy, he bought 25 million the week that the stock was dropping like a rock. So far more bullish I am on UNH than I am bearish. I'm not bearish. Although HSBC is so-called bearish on the stock, they got to sit with that moniker for a while. I wonder who was buying that stock on that dip. Maybe a little bit of HSBC. I wonder if they're out there listening. Okay, got my UNH stock at 280. Congratulations on that. We'll keep nibbling every time it dips below 300. Wise strategy. Wise. All right, folks. Thank you all for being here. Don't forget, please head on over TrendSpider. It's an awesome tool. Take advantage of my bare minimum 35% discount. CON35 is the discount code. Link below on YouTube, link above on Facebook and Twitter. Everybody have a profitable trading week and an awesome remainder of your Sunday. Thank you for being here. Like, subscribe. You know the deal. I'll talk to you all soon.